Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion in global GDP, and 10 million jobs. And in support of that mission, we've been doing these free mentoring roundtables for years and years and years, over a decade, actually. We started back in 2008 in the fall, and today we've done 430 sessions, and over 100,000 people have attended these sessions. All recordings are available. So if you are looking for a body of material to listen to while you're commuting or just have time to listen to something, you're welcome to go check out the 1M1M Roundtable's YouTube channel. And it is a very nice body of learning material. If you're live tweeting the show today, please use hashtag 1M1M. You can join us on Twitter at 1M1M or at Romana, and we publish a lot of interesting, informative, educational, inspirational content that you can learn a lot from. This is a roundtable, not a broadcast. So we want you to participate as much as you want to. And these are the call-in numbers. I'll let you know that we're turning the call-in on, and you can dial in and dialogue and weigh in, ask questions, whatever you wish to do, however you wish to participate. In the meantime, make sure you set your chat to send to all participants, the public chat, and you can also correspond with everybody in the room through that. We're going to start today's session with a conversation with Yash Hemaraj, founding partner of Arka Venture Labs and also a partner at Benhamou Global Ventures. Yash, welcome to the show.
Thanks, Ramana. Looking forward to the conversation.
I will first let you introduce what you are doing. I know it's an experimental project, Arka Venture Labs. So tell our audience about Arka, and we'll take it from there.
Absolutely. So we're off to a good start. We launched Arka Venture Lab summer of last year, summer 2018. Arka Venture Labs is India's first B2B focused cross-border accelerator. Our idea is to seed the next wave of enterprise innovation coming from India and connect them to the global ecosystem. Primarily, we are looking at B2B focused companies. So the major markets are North America and Western Europe. So, and in particular, the North American market, and within that, the US market. So those are the markets that we are focused on. And our goal is to provide a platform, an open and collaborative platform for entrepreneurs to come to the US, set up the base over here, and get them the necessary help that these entrepreneurs need in order to be successful in the global markets.
Yes, Yash, we'll talk a little bit about the model, especially what your philosophy of funding is in Arka Venture Labs.
Yeah, so we give about $200K of capital to our founders. And there's a lot of thought that went into this. What we observed was that many accelerators are not giving any cash, or kind of giving only 25K of cash to the founders. And our realization was that the companies that we are dealing with are enterprise companies. The sales cycles are 6 to 9 months, if not more, in some cases. So we wanted to kind of give them enough cash such that they can do two things. One is fast experimentation and fast learning, and have at least 2 or 3 cycles of this by 9 to 12 months. So that is the goal of giving $200K to our founders. Sometimes the founders want to raise slightly more money, up to, let's say, $1 million. So in those cases, we participate with our $200K and also help the founders secure the remaining amount. So that's the capital model that we are going with. But the whole focus of Arka Venture Labs is not just capital, but also providing a platform where the founders can also get the mentorship that they need, get access to the Silicon Valley ecosystem, and also get access to digital and physical infrastructure. So it is about $200K of capital, but also comes with these additional things.
So, folks, audience who are listening, 1 million by 1 million has a partnership with Arka Venture Labs. So all Arka Venture Labs companies will have access to 1M Premium. That is the arrangement we have made. And let's kind of dive down, Yash, a little bit to explain to our audience the criteria for funding. So if you're going to give $200,000 to a founding team, what do you want to see that they have already accomplished before you're willing to write that $200K check?
Yeah. Now, and before I get into the question, we are extremely fortunate to have this partnership with 1M because when it comes to B2B in particular, there are certain things that you can do in order to help the companies. Unlike B2C, B2B is very structured in terms of helping the company scale. So having that collective learnings from lots and lots of entrepreneurs is extremely important, because if the founders do certain things well, they can de-risk the company dramatically. So in that way, I want to underscore the importance of this partnership. So now into your question. So we apply a very rigorous criteria to select the best startups coming from India. So it starts off with, I say 5 things, but the most important thing is strong and passionate founding team who have a unique insight into a business. The unique insight comes from either they're coming from a different industry, applying a new technique or a new thought process into that new industry, or it could be a pain point that they have lived it for a while. Right, so that's where the unique insight and the experience of the founding team counts a lot. The use cases have to be global B2B use cases. There are a lot of companies that have use cases only related to the Indian domestic market. Those are not the companies that we are looking to fund. And in order to kind of help those companies, we want to see that the company have some sort of an MVP, which is ready to scale. I call it MSP, minimum sellable product, so that we are not investing in the technology part of the business, but which happens continuously in early stages. But we would like to kind of see, okay, here is a few set of customers who are ready to buy a product like this, and we help kind of scale the go-to-market teams. We help kind of build that fast experimentation along with the customers in the loop. So that's the MVP side. And the last 2 are what makes the companies really stand out. One is, as we all know, India has a unique talent base of probably the world's largest and also youngest population of computer educated and English educated population. And this provides a core technology differentiation for the companies which are based out of India. Along with that, it also provides a clear economic advantage. The economic advantage in the past used to be just the technology piece, meaning finding developers who can code. But now you can also see that the founders can do inside sales from India, deliver a very high level of customer success for their clients, for their customers. So all these contribute to clear economic advantage, which means that less capital intensity in the business.
Yeah.
So these are the things that we really look for.
One point I will double click on, which comes up a lot, because the reason we have this partnership, folks, is that we have a huge overlap in the Indian market. We do have a big presence. 1 million by 1 million is also very present in the Indian market, and we've been present for a very long time. Especially the whole Indian SaaS category was one that we played a very big role right from the beginning. Now, the question that will come up from founders, I'm just going to put it to you, Yash, and we can kick it around, is a lot of these Indian SaaS companies start with Indian customers. Maybe the first 3 to 5 customers are Indian customers, maybe even a dozen Indian customers, and then they fine-tune the product using Indian customers and then start selling abroad. Is that an okay level of validation for you to write the $200K check, or do you need a US customer already or Western European customer already in the pool before you're willing to write the check?
So I'll answer that question in two parts. First, yes, we are okay with the founders developing what I call as the minimum sellable product in the Indian market, but the kind of customers that they choose has to be carefully selected such that the customer is probably a global customer, like a global bank which have an Indian presence, or it could be a CPG company which has a lot of presence in the Indian market and interest in the Indian market. So who have offices there, who have teams over there. So those are the ideal customers for these companies to work with. Second, this is just an observation that I've seen from a lot of companies that approach us. And one of the common mistakes that people do is when they're working with the Indian market, they totally focus on just the Indian market. And one day they want to pivot to the global markets. When I say the global market, I use the North American or the American market as the proxy for it. And that hard pivots are usually very, very tough. And a lot of times founders say, okay, we are going to relocate completely to the US and then we are going to start experimenting with that market. I think that approach is flawed. I think the better way to kind of approach this is by having periodic visits, let's say once every 2 months or once every 3 months, coming here, connecting to the Valley ecosystem, connecting to customers, and learning about what is the need for the global market and how different that market is from probably the local customers that they're experimenting with. And building the cycle of fast experimentation right from the beginning and incorporating the insights from the global customer base is extremely important. And this has to be done right from day one, than trying to pivot the company at one point and now focusing on a different market. That usually leads to a lot of wasted dollars. So, and that's one of the reasons why Arka Venture Labs kind of emphasizes the need for coming here more often, using the platform that we have built to connect with customers and go back to their teams, experiment, and iterate. So this is how we would like to approach building global B2B companies.
And then the other thing to think about in this selecting customers to go after is, what is the positioning of your company? Are you going after large enterprises? Are you going after mid-market? Are you going after small businesses? And each of them have a slightly different go-to-market strategy. The inside sales point that you raised, Yash, is very interesting because Freshdesk, now Freshworks, for example, is a company that we watched grow from the very beginning. They were in the program for 3 years. And that company actually did not go to the enterprise at all until much, much later in the game. Now they're going after enterprise deals, doing very large deals and so forth. But when they started, they acquired customers, including closing deals, closing paying customers, all on the phone and internet. So it was fully inside sales-driven go-to-market strategy, and they did it all from India. They acquired global customers from sitting in India. And actually, when they raised their Series A, which was a $1 million Series A from Accel, they already had paying customers. And that's something that we decided collectively, is that we were going to validate all the way, including pricing model, revenue model, customer acquisition strategy, customer acquisition cost, everything before going to raise money. So that worked very well, but it only worked because their customer base, target customer base, was small businesses. This doesn't work as well if your main target customer base is enterprises. And you can, in some cases, actually these days, enterprises are also very friendly to working with startups. So you can open conversations and start maybe even pilots with enterprises abroad. But there are, a higher touch selling needs that you have to pay attention to. Yash, I'll let you, weigh in on this point.
So absolutely. To your point on Freshworks, that's one of the companies that we highlight when we talk about what is the potential for Indian founders, and SaaS is a big component and big advantage point for Indian founders because now you can start small, deliver on that customer success. You can do that initial customer acquisition through completely inside sales model, but then really work with the customer to make it successful, and that will lead to larger and larger opportunities over time. So one of our, as we designed the Arka Venture Lab programs, one of our key approaches to this is one-on-one mentoring. What we saw with a lot of accelerators that have been set up is they try to set up a program for 3 months and fit all the companies through that 3-month model. And what we saw, observed, and also discussed with a lot of entrepreneurs was that every company is different. A company that is, targeting a factory floor is going to have a different sales cycle compared to a SaaS business focused on the sales and marketing vertical.
And enterprise accounts in 3 months is going to go absolutely nowhere.
It's not going to go anywhere. So, sometimes you don't even get your first meeting during that time, or you don't have your POC set up. So that's where our need was that our program has to be curated one-on-one. And that's where when we designed the program, our goal was not to kind of start 15, 20, 30 companies in one cohort, but rather have a continuous admission process, have a cohort of about 10 companies every year, and build a cohort of 30 companies over a period of 3 years at least. So that is how we are approaching the market. That allows us to dedicate the amount of time that our entrepreneurs need in order to get that one-on-one mentorship. Even when you're connecting them with mentors, just generic advice about how to build companies, about what are some of the 4 to 5 sales motion which are employed within B2B companies. So those are all table stakes. But on top of it, positioning a company in a particular market, it is such a curated approach because every company is different. The markets, they're different. Their customer bases are different, and their customer segments are different. So you got to kind of dedicate enough time and bandwidth to these companies, and that's the goal of this platform, is to be able to provide this framework, this one-on-one coaching.
So that's another reason why this partnership came together, is that we have in 1 million by 1 million also, it's a rolling admission. Anyone can join at any time. There's no 3-month program. There's no concept of graduation. We are building companies. So what you graduate from, we don't believe in, graduation from an accelerator, really. So I think these are important points, important differentiators, and important markers to pay attention to. The other thing I would point out here is I think both Arka and 1 million by 1 million have a shared philosophy of bootstrapped entrepreneurship. $200,000 is not $200 million. So you can't throw money around. You have to be very capital efficient. You have to spend the money that you have access to very carefully, very conservatively, and on the right things. And this is where laser sharp positioning kicks in gear. If you don't have very good positioning, if you do what we call spray and pray, you're going to run out of $200,000 in a nanosecond. And that's not helpful. That doesn't qualify you for more funding. That's going to make you unfundable. So the $200,000 that you have access to through an Arka relationship, for example, you're going to have to use that very carefully. You're going to have to deploy that very carefully. And you're going to have to achieve concrete customer wins, concrete customer milestones. And that's very much the philosophy of bootstrapping.
Yeah.
I'll let you talk about that, Yash.
No, absolutely. To your point, one of the key indicators for success is, contributors for success is the first 3 to 4 hires that you make within any business. And when you are cash strapped, and when you're taking a bootstrapped approach to this, you cannot entice people with just the salary component. Okay, I'm going to match what a Microsoft is going to give you, or I'm going. So you'll have to bring people on board based on a mission, based on the vision that you have set as the founder of the company, and that mission-oriented approach contributes to a better culture within the startup itself, delivers better results. So I think when founders take such a bootstrap approach to building the companies in the initial stages, it enables them to kind of build a very cohesive unit of the initial 4 to 5 people, 4 to 5 employees, 4 to 5 contributors. I think that will set up the company for success. That's one of the big advantages, in my opinion, of taking a bootstrap approach.
And there is one other very major advantage, which if you've been following some of the articles that we've published recently and have circulated through the newsletter and on LinkedIn and so forth, is the opportunity for bootstrapping to exit. So if you have small capital efficient startups that you have built to a certain level of product market fit, you can achieve wonderful exits, because the truth is most exits happen in the sub $50 million range. Maureen, you may want to share a couple of articles, the bootstrapping to exit article, as well as, actually, since we're talking about Freshworks, we just did a story on Freshworks. They've done 9 acquisitions, and all 9 acquisitions are capital efficient or bootstrap startups, and they've acquired 9 of these, and we did a story on this, analyzing what's happening, and we've done story after story recently in this last 30 days. We've done story after story analyzing what's happening on the acquisition side of B2B SaaS. So I think one of the things that's very attractive about Arka is that you're not chasing unicorns, and I'll let you elaborate on that, Yash.
So you are right on the point with that a lot of companies, especially in the B2B side, get acquired for anywhere from $50 to $100 million. I think there are some statistics that were published very recently, and that's the opportunity where if you have taken in $50 million into your company, there is no way you can sell the company for $50 million and everybody is happy about it, right? So, but on the other hand, when you have taken less than $4 or $5 million to build a good revenue-based company where you have multiple optionalities, right? One is if you're capital efficient, there is always profitability as an option, and continuing to use the customer revenues to continue to build the business. So there's always that option on the table. The second option is M&A, where you see a strategic fit into a slightly larger organization, or sometimes it could be mergers of equals, so that you have a much better operations or much better value prop for your target customers. And finally, you can raise other venture capital if you see the right metrics there, like what Freshworks has now done once they figure out their product market fit at scale. They were able to raise additional amount and go after probably even larger market and larger segments, right? So there's always multiple options on the table, so it's extremely important.
And if you look at the buy side of this story, if you put the Freshworks hat on, that company has raised now a huge amount of money, several $100 million, and they also need to expand that product portfolio. They started as Freshdesk, which was help desk SaaS software. The reason they changed the name of the company to Freshworks is to expand the product portfolio, and that expansion of product portfolio they have done by acquiring companies. So when you look at why they're acquiring and what they're acquiring, they're trying to acquire companies that would expand their product footprint and give them access to different expertise. In some cases, they're acquiring AI companies that brings in kind of acqui-hires of certain types of skill sets and certain types of expertise that they need to be able to get into certain areas. And in all of these cases, though, the capital efficiency of the companies that they're acquiring is something to note. And if you look at other peer groups of Freshworks, for example, we did stories on Atlassian. Atlassian is a very successful bootstrapped Australian company that went public in the US market, and they have been following the same strategy of acquiring capital efficient startups. Smartsheet, another bootstrap company, these are all Atlassian, Smartsheet, Freshworks, these are all bootstrap first, raise money later case studies. So they have raised now huge amounts of money, and then not Freshworks, but the others, Atlassian and Smartsheet, have already gone public. But if you look at their acquisition strategies, there are a lot of they're acquiring companies that have that capital efficiency built in. So it's a lot cheaper for these companies to acquire companies that have not taken huge amounts of funding, and that is far more attractive. So, for example, where this fails on the buy side, I'll give you an example. Aptus is a great story, actually. Aptus bootstrapped to $5 million. They built their entire contract management software product on top of the Salesforce.com platform, Force.com. And then they started raising money. They ended up raising lots of money. And they continued to build on the Salesforce.com platform. But at some point, they had raised so much money that when Salesforce.com was looking to acquire a contract management software company, they did not acquire Aptus. They acquired a small company that was very capital efficient, and they brought that one in. And that put Aptus in a bind, because now Salesforce, that was supposed to be their biggest champion and biggest lead generator, has a competitor, has acquired a competitor. So their exit path got blocked. So that company recently got sold to private equity, and that company could have been a gigantic success. They did a lot of things right, but then they raised too much money. And this is something that you have to be aware of, because there is a lot of money floating in the system. In fact, there's too much money chasing too few deals. So when you start hitting your stride, if you get carried away and raise huge amounts of money, you better have a strategy of doing something that is going to get you to the right exit, because all these investors also need exits and you need exits. So this is a very complex set of strategic moves that you're going to have to think through, and I think, raising lots of capital is something that you should be very, very careful about. And frankly, I have, constantly pushed Freshworks on this topic. If you read my coverage, my personal coverage of Freshworks through the last decade, you will see that I'm constantly holding them publicly accountable for raising so much money and not hitting on profitability. This year, they have hit on profitability, which is a great milestone that I was publicly pushing them on. So, the reason Freshworks is important is because this is the first company out of India to be able to do stuff at this scale, right? No other B2B SaaS company out of India has done things at this scale. They haven't raised this much money. Nobody has raised this much money. Nobody has been following this acquisition strategy. Nobody has been able to hit the kind of revenue levels they've hit. They have hit the 100 million ARR level now. All these are firsts. But I think this opportunity of other people doing it is there. So you're gonna have to play this in different ways. And what Yash is explaining to you out of Arka and the platform that they have created is one strategy of playing this B2B SaaS out of India game strategically, effectively, intelligently. So, Yash, you want to add to that?
No, I completely agree with what you just said. Capital efficiency, paying attention to it, and seeing how that will build an economic advantage for you to and a sustainable advantage is extremely important. And it doesn't come naturally to a lot of people, and the tendency is to get carried away by other companies maybe even within the same sector who have raised additional money. And the biggest mistake that entrepreneurs do is, hey, company X or company Y raised X million dollars from them, and we got to do the same. I think playing the game of your competition in the way they want to be played is a losing value proposition. You got to kind of really build a company around what contributes to your economic advantage, your technology advantage, and your operational advantage. So that's what you got to stay focused and not get carried away by a lot of noise. Yes, when companies do raise in a lot of money, they will generate a lot of noise in the market. They will have pretty much your entire product roadmap into their product roadmap, or some of the features that you differentiate into their product roadmap. But that's where you got to persist on your vision and really work with the customer, and the customer see through what is fluff and what is product roadmap very quickly. So it's about persistence. It's about staying disciplined.
Yes, before we move to the entrepreneur discussions, could you talk a little bit about the 3 venture funds that have put Arka Ventures together, and what do you envision would be their roles in follow-on financing in the companies that come into Arka?
Yeah, so Arka Venture Labs, we wanted to make this an open and powerful platform for our founders. And again, when you're building enterprise companies or B2B focused companies, it is never a one-stage game. It is always, you got to build company in stages. And we wanted to partner with the folks who are united in this mission of providing this open and collaborative partner platform for our Indian entrepreneurs and helping them scale into the global markets. So we partnered with Bloom Ventures and Emergent Ventures along with us at BGV, Benhamou Global Ventures, in order to provide this platform. The 3 of us are the founding VC partners. We have put the seed capital to get the fund rolling and start making investments. And we are also bringing on additional partners, both corporates, family offices, angel investors who otherwise do angel investments on their own into the platform, so that our entrepreneurs have access to a wide variety of network and a wide range of advisors who can advise on go-to-market strategies, positioning, and also around subject matter expertise around particular verticals. Between the 3 funds, we have close to $300 million in assets and management, up to 100 plus companies within the portfolio. So there is a lot of cumulative learning that our founders who are coming into the Arka platform have access to right from day one.
And could you also talk a bit about the company the first company that you have invested in that is also in 1Mby1M, and help our entrepreneurs think through a little bit of what you saw in this company that helped you decide to pull the trigger?
Yeah, so one of our first investments is a company called Primaseller. And Primaseller provides an inventory management solution for omnichannel retail. So the founder had the domain expertise of working in the supply chain business for several years before he started this company. He built the company originally focused on the Indian markets with Indian customers, but very quickly pivoted to the global markets. Has a lot of customers from North America and Western Europe, all of whom have come organically going onto the website and signing on. They have excellent reviews on all the review platforms that where they have voiced their appreciation for the product and how simple it is and how easy to use it is. And so that what we saw was that there was elements of all the things that I previously mentioned in the company. And when you look at what's happening on the retail industry in the US market, you're seeing more and more retail stores being disrupted by the Amazon model. They have to be omni-channel by nature. They have to have operations in their retail stores, but also they have to have a direct-to-customer channel online. And the biggest challenge when you're trying to do this is inventory management. And inventory management is one thing where if you don't do it well, it's a loss-loss situation, meaning if you don't have the right inventory in place, you're going to lose the customer. The customer is going to walk into the next store and buy the product. And if you have too much of inventory, that means that you're incurring a lot of inventory-related costs, both from an opportunity cost of the held-up capital, as well as from the additional expenses that you bear with storage, with all the logistics around it, and wastage. Right. So that's where having right inventory management is a very important problem that all the retailers are currently facing. And what we found was a nice, slick product that a lot of existing customers have already shown appreciation towards. So those are the elements of the company. And now the advantage they have is, they have the operations of a few quarters already into selling to global clients. And now the opportunity is to go slightly up market and increase the average ticket size, increase the product feature set, etc.
Great. Now, we're going to actually go to one of our 1 million by 1 million premium companies it would be great for you to talk to them. Before we go there, one last question, which I tend to ask all investors, is what are you seeing in your deal flow? So with this thesis, with this lens on, in the Indian B2B deal flow, what trends are you seeing?
So the message of Arka Venture Lab is clearly resonating with our founder, with a lot of founders. They really recognize the fact that they need a platform like this in order to be successful. So we are getting a lot of demand, slightly so much that we have had to scale back a little bit in terms of the pace at which we are going. But it's all a good sign that the message is sticking, and the entrepreneurs recognize the need for it. We are also seeing that a lot of times, I'll give you an example of one of the companies that we are currently working on. I cannot disclose a lot about the deal, but the company already has close to $1 to $1.2 million in revenues coming from global customers, and completely profitable or close to profitable. And we are helping the company in 2 or 3 areas that we have identified, and we have already started helping the company there. So that is an example of the need of a platform like this, and entrepreneurs recognizing that even though they have those revenues already in place, they need a platform like this. So I think that is the validation for us that there is a latent demand for this, and our deal flow is representing that. And
can you quote some numbers on how many companies that fit this profile are you seeing? Do you think your assessment is in the Indian market right now that fit this B2B SaaS profile?
Yeah. So I'll speak for the last 6 months, and again, just highlighting the fact that we launched formally in the late summer of 2018. We have seen more than 100 plus companies going through the application process. We have had conversations with about 40 plus of those, where we have had multiple rounds of interviews. We have seen more than 20-25 companies at the investment committee level, and we have completed a couple of investments, and we have about 4 or 5 companies that we are currently working on at the term sheet level. So that's again, that's a showcase of the good momentum that we have with strong deal flow and a few of those converting into initial investments.
So, but you have seen 100. What is your assessment of how many are there? Are we talking 1,000, 2,000, 10,000? How many are we talking?
I think I'm talking thousands. There are thousands of such companies out there, and the challenge is rising above the noise, eliminating the Me Too companies versus companies that have that unique insight, and I think and for the Arka platform, our goal is to carefully select about 10 companies every year on a rolling admission basis and building a portfolio of about 30 companies which can benefit from this. But in order to do that, you've got to see a lot more companies, and our deal flow is representing that. So I would say I think the demand is for the thousands of companies that are coming out.
All right. Well, very interesting discussion and a good view into what's happening in Indian B2B SaaS. It's a segment that we have a lot of activity in, so I hope listeners, you found this interesting and insightful. We are going to switch now to the entrepreneur pitch portion of the conversation. Madhu Augustine and Wilker Ambuchen are doing SnapSupport, which is one of the 1 million by 1 million premium companies. And let me see if I got this right. So, Maureen, is this the right pitch deck that we're going to work off of? And is Madhu or Wilker on the call and ready to pitch?
While you're doing that, Shravan, I really appreciate the conversation today. Thanks for providing all the support that you have been providing for our companies, and look forward to taking this partnership to the next level with a lot more companies and helping them make this transition. So look forward to working with you, and I have a hard cutoff at 9 o'clock, but I'll stay on till then, and then I'll drop off.
Great. That's excellent. I'm sure, is Madhu on the call? I would like to turn this over to Madhu so that you can have a quick conversation with Yash on the platform. And I'm getting chat messages from people who are supposed to pitch and are unable to call in. Guys, come on. So go ahead, Madhu and Wilker, whoever, you need to turn your audio on, otherwise how do you pitch? If you're ready to pitch, please go ahead and start pitching. Is something wrong with the call-in? Maureen, Vijay is sending me private messages saying that he cannot dial in. I don't understand what's going on. All right. Folks, bear with us for a moment. We've had some scaling challenges with WebEx lately.
Sorry, I just joined. This is Madhu Augustine.
All right. Go ahead, Madhu. You can start your presentation.
All right, thank you. Yes, nice to meet you. So we are from SnapSupport, myself, Madhu, and Wilker. So SnapSupport is a smart remote for field technicians. and it's powered by mobile and IoT. So when you look at the equipment industry, so for example, life sciences or medical devices or any other type of equipment, the equipment has evolved quite a bit from, let's say, if you look at the last 10 years, right? They are connected, they are smart. For providing support to their customers, they haven't really evolved. People are still using old tools and also phones and emails, and which is leading to a lot of problems for the field technicians, which is very so one thing, so Maureen, could you make sure you have could you check the slides? I think you have some older slides and not the ones I sent you.
Where, which slides are we talking about?
Yeah, I just emailed the ones that I emailed.
Maureen, I'm sorry. This is very difficult to navigate. I don't think I've ever seen this level of complexity before in one of these sessions. I don't know which slides am I supposed to use. Where are the slides?
Yeah, it looks like she uploaded a slide that we sent last month and not the latest one.
I have 3 sets of slides that have been uploaded into this session. So, Madhu, please go ahead and explain what you're doing without slides. How's that?
No, that's fine. Yeah, I can go through these slides as well. Yeah, so basically what happens is when you don't have the right tools, one of the downsides of that is the customer downtime, right, which is costing a lot of time as well as money. And if you think about the field service teams, as I mentioned, when due to the complexity of the instrument and the lack of the right tools, it's limited access to data and documentation for them when they're in the field to try to figure out and solve an issue. And if they need some expertise, access to an product expertise, there's no easy way for them to access that as well. So what they need to do today is to email someone or try to call someone, and if they're lucky, they'll find someone. Otherwise, they're stuck, right? And which is very frustrating and leading to customer dissatisfaction and high support costs. So if you look at what they need, right, so they need immediate assistance when they're in the field. And capturing that information, which leads into predictive assistance as well, right? So if we know exactly what the technician is going to work on, so can we try to help them proactively? So the training people are doing today, but providing that assistance real time in the field and also being proactive about it is what we need going forward. So that's where SnapSupport really helps these field engineers and really empowers them with the right data, the right knowledge, and the right expertise at the right time. So we have 3 pillars of our platform. The first pillar is the ability to get equipment data in real time. So we use different IoT platforms to make that connection and to bring in the data. And then we have the knowledge base and the machine learning behind it to provide the knowledge to the technician at the right time. So what we do is we collect data from their existing systems, and it learns as it goes, as people use the system more. The system, SnapSupport learns and feeds that data back to the technician at the right time when they need it. And the third pillar is the human expertise. And we can track the experts within the organization and then make sure that they are connected and available when a technician in the field needs help. So those are the three ways of really empowering the field technician or field engineer when they need help, when they need some information. And some of the key use cases for our product, the first one is the remote assistance for people in the field or people in a factory, right? So help them resolve issues very quickly. The second is getting access to the information, equipment information to solve problems. So what we do is we pull the right data, massage it, and give it to them to understand what's going on very quickly. So they don't need to go through complex equipment, complex interfaces, or software to access the data. And the third one is we can even enable customers to get support directly. So not just the field technicians, but the end users of the instruments. Verticals we are targeting right now. So currently our target is 2 out of these. The first one is utilities, where we have customers right now. And the second one is the instruments and equipment space, where there's life sciences equipment and others. So we are actively targeting those 2 verticals. So if you look at our market right now, so I mean the whole space, right? I mean where we are in. So there are collaboration tools provided by Salesforce and Microsoft. There are ticketing systems like Zendesk and Salesforce. And then there are field service management systems like ServiceMax and Click Software. And where we are is we are in between, empower people with information. So we don't deal with the nitty-gritty of the work orders and the work order management. So we look at the next level where how we can empower the technicians. So that's where we fall in. So it's a blue ocean right now. And there's competition like Uptake, where they monitor equipment and provide information. But as I mentioned in the previous slide about the 3 pillars, so we are one of the first ones to bring all 3 aspects together to help technicians figure out and solve problems.
Madhu, do you have your bottom-up TAM analysis in this slide deck?
No, not in this one.
Okay. All right.
So that's the new one, yeah.
Do you remember what
your
bottom-up TAM comes out to be?
Yes, let me quickly check here.
So folks, while Madhu is checking his numbers, I want to tell you one policy issue. If you send multiple versions of slides at the last moment, it's impossible for Maureen to juggle all that and put everything on track. So please, in the future, please do not do this. Every time we have to juggle through these multiple versions of slides, there are problems. And we are very flexible, we are very patient with you. Please don't take advantage of that. It's not fair. Madhu?
Yeah, so the way we are looking at the market, the sizing the market is looking at the number of technicians in each of the verticals that we are going after. So what we are finding is globally there are 9.2 million technicians in businesses of varying sizes. And when we filter that by the size of the businesses we want to target, which is anywhere from 20 technicians onwards, and there is right. So there are some businesses where you don't really need to provide assistance to people in the field teams. So we come down to 5.5 million users or technicians who can use our software. And at our list price, which is $25 per user, so that comes to 1.6 billion opportunity for us.
Okay. And you currently have 2 paying customers or more?
So 2 fully paying customers. I mean, there's a third one. They're paying some custom charges, but not really. It's not a recurring revenue. So 2 customers who pay an MRR, monthly recurring fees. And there are 3 pilot customers in progress, and one of them could be converting very soon, as early as next week. So they're meeting on the 17th to review the POC objectives and make a decision. And they're meeting with their end users and getting their feedback. So I think we will know early next week. And the second POC customer is actively using the software and happy so far. So looking good there. And the third one is not very active, but we are still hopeful that they'll convert at some point in the near future. And in terms of our go-to-market strategy, so primarily we are focusing on two aspects right now. So one is direct sales. So we are generating leads through conferences primarily, and then going after them through our own sales efforts. And the second one is through partners. So we have two partners that we are working with. One is TCS in India and in the US. So we are already talking to some of their customers that they brought to us. So it's going very well, that partnership. And the second one is a company in Japan. So they are also a big system there. So we are in advanced discussions with them. And then Siemens platform for our support system and connecting it to their IoT platform, the MindSphere. So that's also in progress. And Siemens is really making a big push into IoT and equipment maintenance and support.
Now, what are the terms of Siemens? Is that an exclusive, or can you explore others? Because we have a good relationship with Schneider, and if you want to start that discussion, and if you have bandwidth, we can get that started as well.
Absolutely. I think Schneider will be a great partner. Siemens discussion is not exclusive. So Siemens has a lot of customers and who need a support solution connected to IoT. So that's where we come in. So what we are doing is we are connecting to their MindSphere platform and making the application available through their store to their customers. But there's no exclusivity at all.
Okay. Well, we can take that offline and get that going.
Yeah. And then accelerators. So currently we were part of Plug and Play, so that has helped us connect with corporate partners and get connections. And since some of our customers are in Australia, so we were part of the Unearthed Australia program, where we connect you to mining companies and utilities and resources companies there.
Okay. So hold on, Madhu. I know Yash has to run in 3 minutes, so I'll let Yash ask you questions before he goes.
Sure. Yeah, that would be great.
So one area which kind of really impacts your capital intensity is, would you need any specific hardware? I think 2 or 3 slides before you showed the 3 things that you're doing. So in this example where you have equipment data, do you need any particular hardware to collect this equipment data, or where are you getting your data from?
Yeah, it's a great question. So we don't do any hardware and nothing on the hardware side at all. So what we're doing is, so that was a challenge initially when we started. So how do you get equipment data? Because you have to customize your software to connect to different equipment platforms, right? So what we're doing now is standardizing on IoT systems, like the that we mentioned, because that standardizes our interface to the equipment. And we don't need to worry about what the native equipment interface is. And the second platform we are using is the Amazon IoT Core. Same thing there. So we connect with Amazon IoT, and then the customer is now responsible for making sure that their connection is there from their equipment to the IoT platform. And the third thing we are currently doing is the sensor companies, right? So there are a few sensor companies that we are talking to. They have a lot of customers to monitor the equipment through their sensors, and they've already done the equipment connection. So we don't need to worry about any hardware at all. And we connect to their software platform to pull the data and do the analysis.
And what's the unique advantage that you bring in that probably these, the sensor companies or let's say, who also probably use solutions like AWS, etc.
Right. Yeah.
Not able to deliver that you're able to deliver uniquely.
Yes. So what the sensor companies do is to connect to the equipment and to get the data, and they also do prediction in some cases, right? They can predict when the instrument might go bad. So what we bring to the table is if there is an issue, if they notice something, or if there is a signal that is coming which could be indicative of an issue, then we take over. And the sensor companies don't do that. So they are not equipped, or they are not interested in building that support ecosystem with their software. So that's where we come in and provide the knowledge base and the human experts, right? Connecting the knowledge base and the human experts to that equation of the equipment data. So we have learned, so let's say there was a bad signal and someone came and fixed that issue. So now how do we action between the expert and the person who fixed the issue? So we take all that into our database. And then also making sure that they can connect to the right expert at the right time to come and look at the issue. And then if the same thing happens in the future, now we know exactly what to do, and we can provide the right recommendation and all that. So it's a great complementary solution that we have with the sensor companies.
Got it. I have to head out, but if I can leave you with a couple of things to think about. I noticed that you're doing, you're talking about 5 different verticals. It's too much of a stretch, even for very well capitalized companies. And one of the common mistakes that I think even companies like Uptake are doing is to kind of stretch themselves too thin across being. I even saw Uptake at a cybersecurity conference very recently. So it's doing too many things loosely will not contribute to your moat. So rather kind of focusing on one small thing, no matter how small it is, but doing it really, really well would be better. So even if you don't have 5 use cases, if you're just focusing on 2, that's what you said, but your
so
slide deck shows 5.
I'm going to intervene in this one. I think if you saw the next rev of the slides, you'd probably have that issue addressed, because we have discussed that offline as well in our private roundtable.
Yes. Yeah.
No. Yeah. So any questions for
definitely. So I think that's a great point. So we will definitely make sure that we focus. And then any suggestions with regard to B2B partnerships, right? So as I mentioned, we are trying to deal with, let's say, Siemens and then Amazon. Does the same thing apply here as well, or do we just cast a slightly wider net when it comes to partnerships with companies like TCS or Siemens?
All right. Well, Yash, we need to let you go, I think.
So very quickly, I think you're on the right track with the equipment manufacturers, and I think my suggestion there is that from our experience, such partnerships suck a lot of bandwidth out of you. So just focusing on 1 or 2, but making them extremely productive would be a better use of time than kind of creating a wider set of these partnerships, because each one is going to suck a lot of bandwidth in order to make them productive, or before you make them productive. Right. Yeah. Thanks, Madhu, and thanks, Ramana. Thanks for having me here. And it's my pleasure.
Thank you. Yeah.
And I'm going to hop off now, and sorry that I have to hop off, but it's a pre-existing meeting that I
No problem. No problem.
Okay. Thanks.
So,
bye.
Madhu, bye-bye.
Yes.
Madhu, since we don't have the updated slides, could you catch me up on what you decided? Because one of the things that you showed was there's some verticals in which you have this massive savings that you're delivering, and we kind of said that we were going to go after those as the target verticals. Where are you in that thought process or in that discussion?
Yes. So I think so the 2 verticals that I showed you last time when we met one was the telecom vertical, where the number of transactions are more, but the technical expertise needed is not that great, right? So telecom technicians go try to fix an issue, But I mean, most people may be able to figure it out, right? So the expertise level is not that high. But when it comes to big equipment, instruments in the bottom right one, any small delay, right, or any issue could lead to massive customer dissatisfaction or cost of not being able to do work while the equipment is down, right? So those are the two variables. And then, so our current focus is the second case where we can make an impact, right? And the issue may not happen all the time, but when the issue happens, if you don't have a tool like this, then impact is going to be huge. And we are getting the same feedback from the customers we are talking as well. So that's really where we are focusing. And
so
some of the pilot data that
where are you paying customers and POCs right now? Do they fit that criteria of high impact?
So the one customer is in telecom, so fiber optics. So it's not very low technical complexity like a pure telecom connection. So it's fiber optics, so they still need some high expertise. And if you cannot make a commercial connection, then the downside of not being able to make that connection is also high. So they fit some of the criteria, but they're not very complex equipment in the field, right? So those are fiber boxes in buildings and some of the equipment related to fiber as well.
Okay. What about the other two paying customers?
Life sciences equipment, so they definitely meet that criteria where the complexity is high and the impact is also high. And the second one, it's actually two paying are related to fiber, and the third one is life sciences. And one of the POC that we are about to close is neither of these verticals. I mean, they just came to us and they wanted the solution. They are in automotive, the hybrid electric battery repair space. So their customer comes in with a battery and they try to fix it. So even if it's delayed by a few days, it's not a huge impact, but still customer could be unhappy, right? I mean, and not be running for a few days if they cannot deliver. So that's the other customer.
So is there any customer that is in the pipeline that fits the criteria of really this massive impact yet?
No, not the 2 million impact that we discussed, right, or that was in the slide. So where, let's say, mining company where one of the equipment goes down and then the whole production is, and each downtime could be $2 million of impact. So that customer we don't have right now. The life sciences is a closer one. So let's say it's a sequencing center and the Thermo Fisher equipment they're using is down. It could be a massive impact, right? So yes, I think they do fit that criteria to some extent, yes.
So my point is, I'm not seeing your most recent set of slides, but just talking to you, the things that I would be looking for if I have to fund this company is one, relevant verticals where you can make that massive impact, and POCs in those verticals, and the TAM for those verticals. So if it's mining, then what is what kind of TAM are we talking about in mining? And I would like to see POCs in mining. Otherwise, raising $1 million without any of that validation, when you're saying that you want to do something and you're doing something else, is going to be a little bit difficult, I think.
Yeah, the TAM in life sciences is $64 million. And then the telecom plus utilities, where we have customers, is $17 million.
So, but are those what you want to go after, or are you trying to go after the high impact ones? That's the real question. I asked you this question earlier also. What are you going after?
Yeah, so what we are saying is, we do definitely want to go after the mining, but the issue getting into a bigger tier one mining is very time consuming. because they are very traditional. Then you have to go through one of their suppliers first, which we are working on right now. Whereas in life sciences, the impact is equally high. It may not be $2 million, but it could be $1 million or $500,000 for each downtime. But it's easier to get that customer.
So if you're going to lead with
that,
this needs to be absolutely clear in your presentation.
Okay.
Is your leading vertical, your key vertical that you're going into is life sciences, where you have significant impact. You should quantify the ROI, use the templates in the curriculum, and the TAM, the bottom-up TAM for life sciences, given your focus and your impact, ROI, pricing, etc., is $64 million. So that needs to be very clear, and that you're going to execute on that vertical and get to, let's say, maybe the $1 million that you raise in the immediate next round of financing is going to get you to whatever is that in that timeline. What kind of numbers can you do? How many of these customers? How many of these POCs can you get into? And that's really what you're selling. Is the Series A milestone is going to be, 1 million is in today's terminology is considered kind of like a seed. It's a seed, post-seed kind of investment, even a pre-Series A. It's not a full Series A. So with that, you're basically setting yourself up to go into Series A. So you're working on the $64 million TAM in life sciences, and you will, get significant validation and significant revenue out of that segment and significant pipeline out of that segment before you raise Series A. That is a story that needs to become clear in your presentation.
Okay.
Right now, we gave you a heads up on this opportunity to pitch about 6 weeks back, and you just wasted this opportunity. You could have made a much, much, much more powerful impact on Yash in this meeting, and you didn't. And that's really unfortunate, right?
Yeah, absolutely. I agree. Completely agree.
So, I can create opportunities for you. If you're going to blow those opportunities, I can't retrieve. You just made a not that great first impression on a situation that I created where you could have you could have knocked the socks off this guy.
Right.
So this kind of sloppiness is not going to work.
Yeah.
So just to reiterate what you need to do, you need to focus on a vertical and show that story of this is where you have POCs, this is where you have pipeline, this is where you're closing deals, and this is the TAM for this particular opportunity, and that's what you're going to focus on now. And after Series A, so for Series A, this is the strategy. After Series A, so you raise 1 million, you'll build up this opportunity, deliver whatever revenue you think is reasonable to deliver. We need to look at that together, and then take that, deliver on that opportunity when you go out to raise Series A. Then you raise Series A, and you're going to open up a second vertical. And what is that second vertical? You're going to have to show the same thing again. You're going to continue to focus on the life sciences vertical and continue to grow revenues through life sciences. After Series A financing, open up a second vertical. What is that vertical? What is the TAM on that vertical? What is the strategy on that vertical? And so on. So life sciences is your pre-Series A, Series A vertical target. There's going to be a second vertical target from Series A, Series B onwards. And then there's going to be a third vertical from Series B, Series C onwards. So that's the story that you need to tell for an investor to be interested in you.
Yeah. That's very clear. Yeah, as we discussed previously, right, we have been having confusion about which vertical to really focus on, because we got some traction in telecom, but we know if you look at the impact of the downtime, it's not that big. But then in the other segment, it's slightly difficult to penetrate, but then the impact is higher. So we've been kind of trying different things to define that very clearly. But I think now we have that clarity of focus and then going after that specific segment. So, in fact, end of next week, we are in San Diego.
You're going to need to do 1, 2, and 3, because VCs are not investing in a $64 million TAM, most likely. You're going to have to show them a higher TAM. So you need to kind of show what is the TAM for each of these verticals and what's involved in each of these verticals. And each of these verticals may have requirements in terms of partnerships, right? The question that you just got from Yash about sensor data. So what is the source of sensor data in case of life sciences? Are there specific systems and specific maybe Siemens. Siemens is a big player in medical devices, so maybe Siemens is going to provide you with that data, but all that strategy needs to be presented. So this pitch really was not good. I have to be absolutely candid. This is not a good pitch. This was a really lousy pitch. So you could have done a lot better than that if you worked on it. So please don't do that again.
Absolutely, yeah. We completely apologize for that. So that, we take care of it.
So before you're showing that you want to raise $1 million by the end of this quarter, but you don't have a pitch that can raise any money at all. So let's first things first, put a pitch together that is a fundable pitch and iterate in the private roundtables and get this to a level where you can, have meaningful financing discussions.
Right, yeah.
Yeah? So as you know, you can come back as many times as you want to the private roundtables, to the in-person rendezvous, and let's tighten this up as soon as possible.
Absolutely. Our whole focus is on that right now.
Okay. All right. Good luck. I'll see you at one of the upcoming meetings, in person or online.
All right. Yeah. Thank you very much, Ramana.
You're very welcome. Okay, folks, I'm going to give you a quick overview of how to use 1 million by 1 million. If you like what we are doing here, please refer the program to serious entrepreneurs. And I will tell you one thing, 1 by 1 million is not for everybody. We operate on a very rigorous basis. All these strategic questions that we're talking about are complex questions. And it takes an enormous amount of work to be able to answer these strategic questions to arrive at a positioning that works. So it's not something that you can very easily wing it. And entrepreneurs who have this attitude of winging it will not fit at all in 1 million by 1 million. We don't wing things, we work. And we are very thorough, very rigorous, and you will get that feedback. One thing I love about Madhu and Wilker is that they are willing to listen to feedback, even though that feedback is not flattering. I'm not giving them a pat in the back that you did a great job. I'm telling you up front that, this was not a great presentation. You need to improve on that presentation, and here are the things that you need to improve on that presentation. That is the spirit of the program. So you're going to need to work on all your open issues, all your gaps in the presentations, in your strategy, in your business, and plug those gaps. Plug methodology gaps, plug strategy gaps, and plug execution gaps so that you can, become credible. So that's really what this program is about. And you please only join the program if you're willing to do the work. Otherwise, it's like a gym. You can't lose weight by buying a gym membership. You have to get on the machines and work, do the workouts. Otherwise, you're not going to get any results out of that gym membership. It's the exact same way with 1 million by 1 million. So if you go to 1Mby1M.com, there's a lot of information, a lot of resources. There's a blog. Just by following the blog, you'll learn a lot. There's the Entrepreneur Journeys book series that we've published on Amazon. There are 12 volumes. You can learn from those. You can come to these roundtables. You can listen to the recordings of these roundtables. Our full premium program, which Madhu and Wilker are members of and many others are members of, gives you the full acceleration program, full methodology guidance. There's an online curriculum. We help you with business development where appropriate. And I think in the case of Madhu and Wilker, I think, yeah, she's absolutely right, is that you have to take each of these partnerships and fully execute on the partnership rather than opening multiple new partnerships. So this is why I asked you the question about where are you with Siemens and where are you, do you have more bandwidth to start another one, because it's going to suck up your bandwidth. So I would say that given where you are with Siemens and the fact that your life sciences is your focus, Siemens may be a very good one to execute on fully, make sure that the data tie-ins are all figured out, and Siemens start generating life sciences leads for you. Get that partnership to that point, and then you can open up Schneider when you take on another vertical where Schneider has presence. I think Siemens is important because life sciences is your number 1 vertical. So, and Siemens has a presence in life sciences. So that's a very good choice, but you need to fully execute on that vertical rather than starting talking to multiple different random, players. And that's the philosophy you will see in business development. You kind of need to focus on strategic accounts and strategic partnerships, both from a customer point of view as well as from a partnership point of view, channel point of view. If your target vertical, if your first target vertical is life sciences, then the POCs need to be in life sciences, the paying customers need to be in life sciences, and the pipeline needs to be in life sciences. You can't say that your paying customers are in telecom, but your first vertical of choice is life sciences. So all this needs to be squared away and straightened out before you can raise money. So all this strategic guidance is part of the premium program usually. And of course, we also help you with financing and media relations. All that is part of the $1,000 annual membership fee program. We have a self-assessment, and I recommend all of you to put your businesses through the self-assessment questionnaire on the website. It's free, and it asks you the questions that you will have to answer, and investors will ask you these questions. 1M Basic is a curriculum-only option that you can use to plug your methodology gaps. As you try to answer the self-assessment questions, you will encounter methodology gaps, and the curriculum will help you address those. So dig around on the website. There's lots of information about the programs, FAQs, video FAQs, all kinds of things. And the curriculum is fully described in lots of details on how to use the curriculum. It's a case study-based curriculum, case studies and video lectures, case studies of over 1,000 successful entrepreneurs, including 100+ unicorns, 400+ venture-funded companies, and 400+ bootstrap success stories. So it's it's intense, and you're going to be studying a lot, but also you're going to be able to use what you're learning from the curriculum in the actual business building process immediately. It's very actionable, very immediate. Our methodology is lean, capital efficient, bootstrap startups. We talked a lot about that earlier today. The philosophy is bootstrap first, raise money later. And that's it. So right now, we are doing free roundtables every week. You're welcome to come and discuss your businesses, your strategies anytime. Go ahead to the free public roundtable page and register for a slot, and Maureen will make sure that you have a slot booked. We also have rendezvous, in-person rendezvous, every other week in Menlo Park at Cafe Boroni. The next one is on Wednesday, February 27th. It's 5 to 6 p.m. Pacific time. And that's it. So we have time for Q&A. If you would like to call in and ask questions, please go ahead and do that. While you're thinking about what questions to ask, let me introduce you to Irina Patterson. If you have questions about the program, you can contact Irina, and she will answer any of your questions. Maureen, the slides needs to be updated big time. Vasu, Oh, no, actually, no, I confused that. I actually don't have an updated revenue number for that, so you may want to check with him. I'm pretty sure it's above $1 million now. Well above. All right. Questions, folks? Questions, comments? Okay, if no questions and no comments, then I'm going to wrap up and adjourn the session. We will be back here with the same format. You're welcome to book your slot and come present and discuss your business next time. And see you then. Bye.